Hello everyone. I'm Mike. Today we have actually Alex Young from who is a vice president from Samsung Asset Management. So actually we'll be actually doing a so-called two session webinar today. So I will carry out the first hour of the webinar. Subsequently, I'll hand over to him to carry out the second portion of the webinar. And for this webinar will be actually recorded. So we'll begin our webinar. So for me, for the content what I'm covering is actually REITs investment, fundamental of REITs, and how doing some case study and some investment strategy that you can actually invest into REITs. So I believe most of you already have started your investment in REITs. So it's actually known as Real Estate Investment Trust. So it's actually offer a investor opportunity to invest in a professional managed portfolio of real estates. So for your case, for most people, right, they are thinking of investing in property, but to actually buy a property may require 100K or even millions of dollars to buy a single property, and it's actually concentrated in just one property alone. However, if you actually do invest into real estate investment trust, right, is actually a professional managed portfolio of real estates. It can be actually coming from different sectors. So in these seminars, webinars, right, we actually discuss more about this. So in Singapore, there are actually over 40 REITs from coming from around the world. You have from US, Europe, Indonesia, and also other countries. So they give an average 3 to 7% yield and is listed in Singapore SGX. So when you invest in REITs, right, the main objective is actually dividend income from the rental income. It's like you buy a property, then you rent out and collect the rental income from that. It's the same for real estate investment trust. Second thing will be, in case there's a property, right, they actually grow in terms of cap value, the price actually appreciated over time. Sometimes some of these may offload the REIT property and they go reinvest into other property. So you can also get capital gain from profitable sales of real estate. The next thing will be actually fundamental of REITs. So when we are looking into REITs, right, we need to understand what the fundamental of. So actually I've grouped them into 9 different category. First one, we'll look in terms of sectors, then followed by actually price to book ratio, who are the sponsor, gearing ratio, cost of debt, interest coverage ratio, reals, occupancy rate, and lastly, the most important is dividend yield also. So when we look in terms of REITs, there are actually many different kind of sectors. So first one we'll talk about is actually healthcare. Healthcare for us, the most well known to us is actually Parkway Real Estate, Parkway Life Real Estate. So it actually help to provide healthcare services. So in this case, for healthcare services, tend to be more resilient. So their price to book ratio actually tend to be also higher. Next will be actually data center. In Singapore, wise data center, we have just one pure data center REIT is actually the Keppel DC REITs. And we also see that there are other REITs that go into data center also in the future. Hospitality is one of them is actually CDL Hospitality Trust. There's also Escorts Trust, but all these are so-called being affected by COVID-19 recently because of the tourism and the lockdown. Next will be retail. Retail, we actually have Lipo Mall Trust. We also have Fraser Center Point. And next one will be actually commercial, Maple Tree Commercial Trust. Then industry, we have the Ascendant Street. And we do take note that some of these streets, right, they are not just purely in one sector. We can see that actually for Ascendant Street, right, they are a mixture of industrial and commercial. Same for the Maple Tree Commercial Trust also. So you can see that actually all these, a lot of REITs, they don't just focus on one. As they merge, right, they will have actually a diversified sector also. Like recently, one of the merger is actually CapitaLand Mall Trust and the CapitaLand Commercial Trust. So they form the CapitaLand Integrated Trust. So next thing is that we will look in terms of defensive and sensitive to economic cycle. Just now you mentioned that healthcare is actually more of defensive. Regardless whether there's any COVID-19, if you actually require healthcare, right, people always go back to the hospital, especially when there's actually aging population. So with this aging population, right, you will actually increase the demand for all these kind of healthcare services also. Next thing will be data center. We know that we need to invest in all this. We also need to take note of what is the long-term trend. So one of the long-term trends is actually technology and cloud service. All this actually require a lot of data storage. So data center will be actually very important, and we'll expect them to grow in higher demand in the future. Also, working from home also actually we are working on the cloud, so this will also increase demand for. Next will be actually retail. So retail wise, we actually have grouped into two categories for retail, because we have a suburban mall, the neighborhood retail mall that are catering to our daily needs, and also we have retail malls that actually cater to more of the tourism. So those retail malls that are actually more catered in the town area to tourism, they'll be more affected. Next will be actually commercial industrial trust. Lastly is the hospitality. So in case of any recession, right, hospitality will always be the sector that will be actually affected the most. And also especially with COVID-19, you can see the country being locked down. So hospitality are actually really affected significantly. So although we say that all the REITs are actually in the same, there are many REITs inside the same sector, but they are not equally. Like for example, we just now talk about healthcare REITs. In Singapore, we actually have two different healthcare REITs. One just now we mentioned is actually the Parkway Life REITs. The next one is actually First REIT. So First REIT is actually dealing with healthcare in Indonesia. So later we also understand why actually all these other factors like sponsor will actually indirectly affect the REIT's performance also. So one of the things people always tend to look is actually price to book ratio. So it's a measurement of share price against their net asset value. So this is actually how we calculate, but in reality, we do not need to do any calculation. All this data can be actually found on SGX or any information website. So in general, above one, you tend to mention that it's overvalued. Below one is actually undervalued. And it always varies across different sectors. So for those sectors that are more resilient, right, you can see like healthcare and data center, they tend to have a very high price to book ratio. You can see Parkway Life real estate is around 2.142 and data center is already 2.5. So you can see they tend to have a very high price to book ratio. However, if you look others, it's like hospitality, like CDL, hospitality trust, they tend to, because they are affected by all these tourism sectors, so actually the price to book ratio will be actually below 1. One thing is sometimes we see very low to price book ratio, right? It also means that there are some issue with the fundamental of the REITs. So when we are actually compare price to book ratio, we need to compare REITs that are inside the same category also. So here is another example. All these are actually more towards the retail mall. You can see actually for Fraser Center Point, right? This one they tend to have a much higher price to book ratio is 1.159, because you know that in Singapore wise we can't really travel. We are actually stuck on this island, and all these urban mall, neighborhood mall, we tend to visit them more frequently, and also our food services like Grab delivery, right? All these food, right, they may also come from all these neighborhood retail malls. So Fraser Center Point is actually one of the key players in all these suburban malls. So that's why they tend to be more resilient. As compared to land lease is a bit more towards in the town area, and also they have some commercial property overseas. So you can see actually the price to book ratio do differ. And lastly, you look at Lipo Mall Trust, they have a very low price to book ratio, 0.273. So we need to understand that this Lipo Mall Trust is actually operating retail malls in Indonesia. So recently, are doing a lot of rights issue to actually buy a new mall. Also, mainly another reason is that actually their sponsor, Lipo Karachi, is actually facing a lot so-called cash flow and debt issue in Indonesia. That's why you also see that if you're comparing Parkway, the Parkway REITs, right, as compared to the First REIT, right, First REIT is also actually facing with a very low price to book ratio. So sponsor indirectly can actually affect the price of these REITs. So do remember that not all the REITs in the same sector are created equally. Just now we also talk about sponsor. So most of the Singapore REITs, we have a sponsor. So actually sponsors are usually the major shareholder of the REITs. So they hold a significant portion of the REITs. And they also usually are so-called property developers, or right, they are holding some property investment. They are able to actually sell at a fair or low price value property and into the REITs, and they can help the REITs to grow over time. So one of the things that people will look out for is how much percentage of the sponsor is owning in this particular REITs. So let's say REITs A have a higher sponsor hold a higher percentage as compared to REITs B hold a lower percentage. REITs A, the sponsor, right, will tend to actually focus to take care of these REITs and help them grow better because they have actually a stake in these holdings. However, as compared to REITs B, the sponsor who have a lower holding, right, they may not actually be so willing to take care so much. They may consider more focus on the main company itself. And also with a stronger sponsor, right, also means that there will be also lower interest rate on credit borrowed by the REITs from the bank because of the strong sponsor, give them more credibility to do borrowing. So strong sponsor also can help them to lower the interest rate. And with lower interest rate means that actually you will get more returns also. And also for REITs, why they actually have the right of first refusal of the sponsor assets, means that if sponsors are going to sell their asset, right, they have the these REITs have the rights to get on hold of this property before they are actually sold into the public market. Next thing is what we need to look out for, because especially with COVID-19 also so-called, right, we need to take note of the debt issue, because in case company are not able to pay for their debts, this one can actually affect their so-called operation. So you can see actually Lippo actually have quite a lot so-called debt issue in Indonesia and cash flow issue. That's why it's very important for a company to have actually healthy debt ratio, and they do not depend on debts to actually so-called service their operations. So one of the way we look at is actually gearing ratio is amount of debt over their total assets. So higher ratio means that they have higher debts. So in Singapore wise, there's a change in regulation. Last time used to be around 45%. Now in Singapore, you can actually borrow up to 50% of the total asset. So you can see over here, for all these REITs, right, they actually have quite a healthy gearing ratio. So one thing is about gearing ratio, right? Let's say if there's actually opportunity in the market to get another property at a low price, attractive price. So what they can use is actually they can make use of their gearing ratio with maybe some injection of equity funds, right? They can actually acquire asset. So with a lowering gearing ratio, give them more opportunity and more freedom to acquire new assets. So another thing is that we also look out for so-called how much of their interest rate is being hedged. So all these detail, right, you usually can find actually from the company latest financial reports. So I gather all this data actually from their financial report. It's quite easy to find all this. So it was very important to take note of financing of interest rate, because when interest rate is going down, we actually prefer them to actually do more of a floating. In case interest rates going up, you prefer them to do hedging at a fixed rate. Just now we mentioned cost of debt. So it's actually the effective rate company pay on current debts. Like for example, you actually go to buy a housing or a HDB or maybe a condo or maybe bungalow. What you look out for, you compare all the different banks, right? How much interest they are focused. It's same for we are offering on the company. So that's why it's very important to see which banks can offer me the best rate. So for REITs, why they also do comparison, which REITs is actually getting able to, if a strong sponsor, right, they can actually get a much lower rate as compared to other REITs that do not have a strong sponsor. That's why cost of debt is very important. So it can be fixed or floating. How you call it? So in general, lower ratio always better because they are paying. Let's say I earn $100, I only have to pay $1, as compared to maybe I earn $100, I have to pay $2 out of that. So that's why lower ratio is always better. And it's also important to take note of the interest rate environment. So you can see that currently the interest rate environment is actually more of a loosen monetary policy. So it means that they actually are so-called lowering down their interest rate. And this one is actually also beneficial for REITs because they can also make use of their gearing ratio and acquire more assets to help them grow. Next thing is that last time we don't look actually in interest cover ratio, but because of the increase of 45% to 50% on the gearing ratio, they also MAS has also come out with the interest coverage ratio. It determines the capability of a company to pay interest on the outstanding debt. So this is actually how you do calculation. So in general, ratio less than 1 means that actually the company is not generating sufficient revenue to even pay for their interest expenses. Next thing you'll be worried whether they are actually able to pay you dividends. Also, there's a requirement to meet the 2.5 by 2020. This is actually a requirement set by MAS. So in Singapore wise, so you can see actually most of our REITs in Singapore, they are able to meet this interest coverage ratio, so 2.5. And also one thing is that when we look at ratio, I do not just look at one point of time. We also look them over time. You see that in case of REITs, right, let's say I used to have 10 times of this interest coverage ratio, and suddenly you drop to 5, you drop to 3, you drop to 2.5. Next thing I have to worry whether this one is going to be below 2.5. In case they are not able to meet this requirement, then whether they are able to pay out dividend or they have to do rights issue to actually keep the company sustainable. So this one we actually seen in the first REITs that actually they have to do a so-called rights issue to raise funds to keep the company working. Next thing will be WALEs. What we call is actually weighted average lease expiry. So it's actually a metric to measure the property portfolio of risk of going vacant. So actually with a longer WALE means more stability, and shorter WALEs also may face higher costs in terms of lease agent fee, advertising, and legal fees. So let's say we have a REITs A and B. REITs A will have maybe 5 years, but REITs B maybe 1 year. So you can see that REITs B means that their average tenures, right, they will be actually expiring in 1 year time. So in this case, right, you have to actually constantly, let's say after the lease expire, the tenant decide to move out, then you have to find new tenant to come to replace this space. So all this will have high cost in terms of this leasing fee, advertising, also legal fee. However, sometimes shorter WALEs may also have their advantage, but in COVID-19, it may not have the advantage because people are going to, so-called tenants are going to negotiate the rental downwards. However, when there's actually limited supply, and there's a lot demand for all this rental spacing, right? Then in this case, shorter will have the advantage because rental there's demand high, supply low, the REITs manager will be able to actually negotiate for a rental hike, increase of price. Next thing is that we also look at occupancy rate. So it's actually the ratio of rented space compared to available space. So one thing is that for me personally, I prefer to look at REITs that actually have a rental occupancy rate above 90%. And also maybe, if possible, 100%, because let's say if a REIT, they are able to rent out all their space fully, means that I will be able to get the full so-called rental income and higher dividend yield. So one thing is that we look at comparison with past number, means that we look at how the REIT manager perform. Let's say if a REIT is able to constantly keep their percentage above 90%, this will be better than the REITs that have a fluctuation 80%, 90%, 80%. Because when you have empty space, means that they are not correcting any rental income on that. That's why we always look at a very high and improving occupancy rate. Next thing is that when we look at some of these more, maybe this one mainly more towards the retail mall, we usually look out for anchor tenders or the draw tenders or the key tenders. Usually all these actually occupy a significant portion of the property, or they are very able to draw the crowd. Usually look at these supermarket. So usually a well-established anchor tenders are very important indicators. And in case these anchor tenants choose to leave, it may not be easy to actually find a replacement for this space. So just see, usually when you go to retail malls, and those malls that have very good location or they are able to attract crowd, right? You also see McDonald's over there. So McDonald's is also very selective when they actually open their stuff. They do not just open at every single location. They will open at where there are actually so-called crowd flow, because when there's actually crowd flow means that there will be actually people are coming in to do shopping and window shopping. Even sometimes you do window shopping, they may be able to purchase some of this stuff also. Next thing is also Starbucks is another key anchor tenders other than those supermarket. And one thing is that recently we can see that there's quite a lot. Some of these anchor tenants like Robinson, they're actually closing down. So sometimes it's that we also need to keep a lookout. If these anchor tenants choose to suddenly leave, it's not easy to find another replacement to so-called occupy this huge space, because they may be occupied maybe around, compared to a normal retail shop, like maybe 10 times or 20 times the retail space. So that's why we need to keep a lookout in case tenants choose to leave, anchor tenants choose to leave. Then we have to see whether they're actually able to find any replacement for that. Lastly, when you actually invest in REITs, right, what you want to do is actually rental income or the dividend payout. So in Singapore, REITs-wise is actually required to pay out 90% of their taxable income. So there are some ways that you can calculate in terms of DPU distribution per unit or in terms of the percentage. And do take note that all the REITs, right, they actually pay out dividend differently. Some of them may be pay out quarterly, some may be semi-annually. So this is actually how you do calculation. So you can see actually for the recently, because there's actually quite a lot of movement in this REITs, and also some of this last year rise, right? Actually, some of these REITs, right, they actually cut down their so-called rental rebates or rental discount to the tenants to help them to actually go through this COVID-19. So you can see actually some of their dividend yield, right, are actually affected lower, and also for hospitality rise, they are also affected. So you can see now all the dividend yield will tend to be on the lower side. As for the Parkway and the Capital DCV, because the price have actually, due to their resilient, people have actually buying up, the share price appreciate. Then you can see share price, how they price per shares. So when the dividend remain the same, price continue to move up, then this one will actually bring down the dividend yields also. Another thing is that when you look at dividend yield, right, sometimes you do not just look at very high percentage. Some REITs they can pay 10%, 12%. However, we need to ask ourselves, are these dividend yield actually sustainable? So one of the best example is actually Lipo Trust. Last time they used to be paying around 10%, 9%, or even 12%. However, you can see when actually things start to hit them, then you can see actually, is their dividend yield sustainable? End up they actually have to cut a lot of their dividend. So, and sometimes in case they are not able to pay even on their existing debts, right, they will not be able to pay some of the dividends also. Another thing is that when you are looking overseas REITs, right, you need to understand whether they are actually collecting their rental, is it in Sing dollar or whether is it in other currency. In case it's in other currency, because we know that FX rate is tend to be actually fluctuating. In this case, we need to understand whether the risk manager are doing any hedging strategy to actually minimize the so-called FX fluctuation. Another thing is that sometimes we also notice that when the REITs actually so-called the sponsor sell the assets to the new to the REITs, right? And in case these property are just newly developed, maybe 1 to 2 years. So during this first stage of the REITs, so-called malls, right, when they do out rental out, right, usually they can give some sort of rental rebate. So this rental are usually, income is usually lower than the market price. What the sponsor will do is sponsor will actually do some kind of income support to top up the difference between the so-called the price of the rental and the market price. Then in this case, right, you may do sponsor for maybe a few years. However, when the income support expire after the few years, it will really depend on the risk manager. Are they able to actually negotiate the rental back to the market price? In case you don't see that they are able to do that, then you can see that actually there's suddenly a huge drop in the rental income. So in summary, right, actually we prefer to have REITs that tend to have a lower gearing ratio. This will give them the ability to acquire assets when there's an opportunity arises, and also lower cost of debt. So means that they are paying lower interest, and also prefer them to have a high interest coverage ratio, so they are able to actually pay out their interest expenses longer wheels, and high and improving occupancy rate is around 90% or more. Lastly, we would like high, but we also want it to be stable. That's why it's very important. So now we'll actually do some case study, because every time we learn something, right, we do actually need to put them into use. So now today I'll be actually discussing Fraser Center Point Trust. So I think if those have been joining the Telegram, I actually talk about this Fraser Center Point quite a number of times. So to have a brief summary of this portfolio overview. So it's actually a retail mall, right? They focus on suburban. Suburban means what we call a neighborhood. So they currently have around 11 suburban malls in Singapore, and they have around 2.3 millions of retail portfolio. Then you can see actually their assets and the catchment. So what is the catchment population? Because they are actually located in neighborhoods where they are actually just next to MRC. So these are key locations because let's say you take a train when you are going home, you'll pass by this mall. Sometimes you just go inside the mall and actually do some shopping. So these are actually very strategic location for the retail mall. So I think last year they actually did some rights issue to actually acquire all this mall for from their so-called the private funds. So you can see their location-wise, right? Especially for retail malls, it's very important to actually locate at key location where they actually serve a lot of crowd. So you also need to know what is the population, future MRT. So they actually are very close proximity to home and transport. So especially even we work from home, right? You also sometimes order food delivery. All this actually come from the nearby retail mall. So they contribute actually catchment area constitute more than 50% of the Singapore population. All these malls are actually well located in with very high traffic flow. So their property, right, after the recent so-called buy into new property, right, actually they are more well diversified. So actually no single property account for more than 22% of the total portfolio. So you can see for Causeway Point, the highest is actually 21.5. The rest is actually around, average is around 10%. So you can see Causeway Point is still considered the highest, but Woodlands tend to have also one of the younger population other than Punggol. So Punggol, what we look out for is actually the waterway point. However, for them, right, they do not have actually own 100% of the waterway point. So there's only a stake of actually based on the 40% stake in the Sapphire Star Trust. So means that this also have a future opportunity to actually do injection of asset to help them this reach further growth. And also maybe in the future, there might possibility also look overseas because Fraser property is not just actually in Singapore also. If you look in terms of Fraser property, right, they also have actually Fraser Logistic and Commercial Trust is located mainly in Australia and also overseas where they are doing some of these logistics services and commercial services. So what they actually focus is essential services, means that they are more resilient. So for Fraser Center Point, because they are belonging to suburban mall, so their retail portfolio, right, around 45.2% is actually more catered to essential services. Then you can see around all this with the F&B, service, supermarket, healthcare is around 53.6%. So now we'll try to understand. So just now we mentioned what we need to look out for, gearing ratio. So you can see actually their gearing ratio recent in the latest so-called financial updates is still 7.7%. Is still way below the 50%. So you can actually give them more opportunity for any acquire of asset in the future. Next thing, we also look out for interest coverage ratio 4.69. It's also be above the requirement of 2.5 times. We also look at their average cost of borrowing because their sponsor wise is I would say that is pretty much quite a strong sponsor. So you can see actually their average cost of borrowing, right, is also around 2.2%. Next thing, how much of the borrowing is actually borrowed of fixed rates is around 49.3%. Other than this, we also look in terms of their debt maturity. So sometimes when you actually have a huge debt, right, so-called expiry in 1 year, then they have to actually negotiate with the bank. So bank-wise, they look, or you have a huge amount of debt. Sometimes it may not actually give you a better rate. However, with actually spread out, right, what they can use is for REITs, wise, they can actually issue of bonds, they can issue borrow from banks or this. So with this, right, actually give them also flexibility. So you can see actually their average debt maturity is around 3 years. And it's actually quite widely spread out. So next thing is that look at our portfolio occupancy rates. So you can see the average is around 96.4%. So it's actually quite, I would say that consider quite healthy. We will continue to monitor because whether actually this one continue to deteriorate or actually continue to improve over time. We prefer them to be at least 90% or even best 100%. Then also we look at how they actually perform in 2019 and 2020. So look at their tendency. You can see actually 2019 and 2020 actually they actually recover quite fast. Although their traffic flow, right, they haven't recovered. Because why does it so? Because many tenant sales, right, means that actually quite a lot of people are not visiting the mall, but they're actually ordering services that come from the mall, like for example your food delivery. So you can see actually now every day quite a lot often, right, you actually order from Grab food delivery. So this will actually bring out the resilience of these suburban malls. So what they mentioned, they are well positioned in the new normal post COVID-19, focusing on essential services, F&B, and necessary shopping. Then you can see their delivery services. They also actually are located in good location next to the MRTs and also population real estate. So they want to actually be also convenient one-stop venue or stop solution for all these family and social meeting. Lastly, I will cover is 3 investment strategy before I actually hand over to Alex. So many people actually ask whether is it a good time to invest in REITs. I think I have heard this question for past few when I come in. So actually we need to focus is that actually one thing is that ability to increase rental. So this one will actually really depend on the managers, risk manager, whether they actually able to manage well and do rental revision. And also sometimes they may do upgrading to improve the mall and attract more crowd. Also for a good risk manager, they are actually able to forecast the demand and supply and actually help them to position themselves in terms of doing the so-called the rental contracts. Also, they are able to pass on the cost to the tenants. Next thing is that we also look out for rental expiry. Other than this, we also look at gearing ratio, also highlight the ability to acquire assets. Lastly, interest rate financing. How are they actually handling this debt? Whether is it they take note of the interest rate environment doing in terms of fixed rate or floating rate? What are the methods they use? Whether is it issue of bonds or actually bank borrowing? What is the cost of financing? This will also partly depend on the sponsor, because with the good sponsor reputation, you can actually borrow at a lower cost. And so that they do spread out their debt maturity. So COVID-19, we understand that actually affected different sector differently. So in terms of hospitality, right, they'll be actually locked down in terms of travel and restriction. So we actually also expect this lockdown and travel restriction continue even with this year, maybe it's dragged towards next year, because you see that there's a lot of vaccine being developed. However, it's not possible to give vaccine development to the whole world. That's why we expect lockdown and travel restriction to continue. And also for business travel, last time we used to actually travel overseas to do discuss of business. However, with this COVID-19, they are not able. So in terms of business travel, there'll be cut down. There'll be people actually doing more business online discussion online through Zoom or this. Retail, so there's actually closure of some of these non-essential trade. So people will actually go more online shopping and also focus on more of essential services. So that's why Fraser Centrepoint tend to be benefit of this, and especially for so-called malls in the town area that are more catered to tourism, then this will also actually really affect them. And also there's a growing of online shopping trend already. Next thing is that looking in terms of offices, there's a trend of people working from home. So you can see actually a lot of companies have actually cut down their offices in some of this commercial space. So this will actually affect the renter. However, in Singapore-wise, we do not really see that affect significantly because we also see that actually inflow of this demand from the so-called China technology company like Tencent, but dance, all these are they're actually operating office in Singapore. So this one they help to offset some of this demand also. Then lastly, industrial. So we expect data center to continue to do well with the technology trend. Next thing is that we also look into other parts of the industrial, logistic online, because logistic will continue to do well because of the growing trend in online shopping. However, you do take note that there's also potential slowdown in certain industry because some industry, right, they continue to face downturn and the outlook may not be so. Some of these company they also may go bankrupt and close down. So industrial they may be affected differently. So someone just has asked what are the recommendation of from Phillip Security. So actually here is a risk table actually from our analyst. What they actually do recommend is actually Escort Residential Trust, Capital Integrated Commercial Trust, Fraser Centrepoint, Tasin, Landlease Global Commercial Trust, Manulife, US and REITs, Ascenders and Kappa DC REITs. So that's why these are some of the risks that you actually consider. So I think that Fraser Centrepoint I think they actually recently did some review again. So you can this one may not be really updated because this one is actually I get from them around 16 January. So if you want, you can actually go to the Stock BNB website to get the latest. So lastly, you cover this strategy. So it's very hard for us to predict when is the bottom or the top. So many people actually try to time market, but when the share price really drop, you'll wonder, is it a good time? They'll actually hang on and wait. So that's why I actually come up with dollar cost averaging and value averaging to help you to actually do investment into risk. So one thing is that regardless of all these strategies, it's very important to understand the fundamental of the target stock. And by putting for dollar cost averaging is actually putting a fixed sum of money on a regular basis to buy shares. It's regardless of the share price. Share price low, you buy more. Share price high, you purchase less. So this is actually how you calculate. So share price to purchase this quarter is actually the amount of, let's say I intend to actually invest 2,500, then it will be actually divided by the share price. So first quarter, share price is 2.13. So with 2,005, I can buy around 1,174. Second quarter, if it's share price of 2.2, then I can actually purchase because share price appreciate. I can buy at the 2.2, I can buy lesser, so it's 1,136. However, when share price actually become lower at 1.9, actually I can purchase more shares. So they actually do dollar cost averaging out. So many people also ask, is there a better way to actually calculate? So next thing is actually about value averaging. We always go supermarket. So last time I used the example of toilet paper. Now I can't use that because people compare investment to toilet paper. So actually I use soap. So let's say if you have a soap bar is $2 and every quarter for your family you need to purchase 4. However, when you see a discount, what do you normally do? Normal housewife and most of us will just stock up. Well, instead of buying 4, we just buy maybe 8, might be 10. We stock up more for the future. So let's say price actually increase back or increase higher, then you can buy lesser in the future because you already stock up in the past. So this one is actually considered a kind of value averaging. When share is very low, you actually purchase even more. So one thing is that same thing under fundamental of the stock. So we already learned the fundamental of the stock just now. Next thing is that you need to set a target investment value to accumulate per quarter. Share price low, purchase more. High, purchase less. Is quite similar to dollar cost averaging, but the calculation is quite different because this one will actually require more time and involvement from the investor. So the same example, we do calculation. So how to calculate is actually share price to purchase this quarter. You need to calculate what is your target investment value minus all of your actual value of your share holding divided by the share price. So let's say I intend to actually increase investment goal by 2,500 per quarter. First quarter is the same amount, 1,174 shares. Second quarter, right, actually because my share price also go up, then in that case, is to meet this 5,000, I do not need to invest 2,500. I will just need to meet the shortfall of 2,418. Then I'll purchase less share. However, when share price drop, right, because I'm further away from my target of investment value, then in this case, I need to actually invest more during this period. So you can see actually there's a different, we do a comparison in the things table. Let's say if we compare a period of less price drop down, especially during 2016 to 2018, you can see actually the price fluctuation, right? From the highest was around 2.27, lowest was 1.9. From dollar cost averaging, you can get again total return is around 12.19%, including the dividend. However, if you are doing value averaging, right, during this period, the total return is around 13.13%. You can see the different value averaging actually outperform the dollar cost averaging by a slightly different in terms of the gain. However, if we actually look at more volatile, so this is the example actually I used to backtest in 2018 to 2010, the previous recession. So you can see actually share price really fluctuate a lot. From 1.46 drop all the way to 0.63, and after that it remained at 0.63 for the next quarter before actually recovering back. So during this period, if you reduce dollar cost averaging, the total return is around 45.63% in the 2.5 years. However, if you do value averaging, right, it's around 70.96%. So in this case, you can see that actually value averaging has really outperformed dollar cost averaging by a huge margin. This is due to the more shares are being purchased when the share price is low and less when the share price is high. You can see actually during this period, sometimes you may need to have more capital outflow into the or capital inflow to the REITs. So it's not like 2,500 per month. You have to actually fluctuate, and you may need additional cash on hand for investment. So lastly, you also come up with another interesting way of investing is price to book averaging. We have to actually study, okay, first thing, fundamental of the stock. Next thing, we also set target investment value to accumulate per quarter. Then we need to actually even study more. We need to see what are the price to book ratio trend, and we need to set a plan to buy. So for example, this is actually the price to book ratio trend for Fraser Center Point from first quarter of 2011 to second quarter of 2020. Then we actually calculate the standard deviation. So you can see how are the standard deviation. So for standard deviation, that is between 1 and below 1 to above 1, we invest 2,500 per month. However, in case when the price actually range is above standard deviation of 2, then we may not invest in that quarter. In case price range is actually below the standard deviation of 2, what we do, we increase the amount to invest. Maybe because when it's above 2, we do not invest. However, when it's below 2, then maybe you can put higher amount, let's say 3,000 or 4,000. So this one you need to set a plan to invest. So there are advantage and limitation of all this strategy. For dollar cost averaging, advantage is hard because most of us cannot time market. So what we do is use dollar cost averaging and also less time and involvement. And this one do not require a large number of money to invest because constantly, let's say you are comfortable to save 500, you can do every 500, you can do maybe quarterly 1,500. One thing is that you also need to think of the fundamental of stock and also do think of the sales chart. So this strategy, right, may be more applicable for people who are using actually cash plus account. And also do think that in case you are really able to time market, this strategy will not be able to outperform. Next thing will be value averaging. Same thing, hard to time market. This one may not require very, very huge amount of money, also like lump sum when the market is at the low. But do take note, sometimes because of this strategy may require a bit more cash upfront during the downturn. However, limitation is because of this, you need to do calculation actively and monitor, maybe quarterly, because all this, right, you need to actually have more time and involvement. And also do take note of fundamental of the stock, sales charge, and also if market is at the bottom. Lastly, price to book ratio is same thing, it's hard to time market, and also we may not have very huge sum of money to do during a downturn. However, this one also require a lot of time and more effort as compared to value averaging, and you also need to take note fundamental, take note of the chart, and also whether the market is at the bottom. So I come to the end of my webinar. So I think I'm ahead slightly. Maybe I'll answer a few questions. Then after that, I'll hand over to Alex for the second portion of the webinar. So actually, how do we know if we are buying a good price for REITs to have room to generate profit? Actually, when you buy a REITs, right, what's your main objective? For us, when you buy a REITs, it's actually for dividend income, not really for growth. If you really want a growth, right, you shouldn't be looking at REITs, because you should be actually looking more in terms of what is the long-term trend, like technology trend, AI, and also EV cars. So in case you want growth, right, you shouldn't be looking at REITs. For REITs, it's actually more for passive income. So how do we know if we are looking at a good price? That's why it's, unless you are able to read technical analysis, or you try to calculate the so-called intrinsic value of this stock, right? Maybe it's actually what you want to do is actually you look at the fundamental. If the REITs is in terms of all these fundamental, they are performing well, right? Then you can actually continue to hold the REITs. And that's why I actually recommend people to use dollar cost or value averaging, because many people have tell me, try to time, like for example, last time I talked about Keppel, these REITs, right? It's only $1 plus. Then people will say, wow, it's above price to book ratio of 1 time. Then people will question, well, whether it's very expensive to buy at 1.4, 1.5. However, you see now the price actually appreciate over time to $3, around $3 now. The price to book ratio is around 2.5. So you can see actually for good REITs, right, if the sponsor, they are doing well, they are managing well, right, they can actually help the REITs to actually continue to grow over time. If they are not managing well, like the Diploma Trust, right, you can see actually the value continue to depreciate over time. Another person asked, price to book ratio is dependent on the company value. So in times of like this, will this ratio be still applicable? Actually, for me, I would say that don't focus too much on the price to book ratio. Let's say if the REIT is really doing well, and the REIT sponsor is strong, they'll continue to continue to grow over time. Okay, for this presentation, right, all this recording will actually be put on YouTube subsequently. Okay, someone has asked if I have a sum for investment, right? What are the top 3 REITs that I would recommend? Okay, I may be a bit biased in this case. First of all, I will prefer Ascendant REITs. So you can see actually Ascendant REITs is still trading, if you compare to the historical price to book ratio, if you do just now the last strategy that I mentioned, like actually Ascendant REIT is still quite attractive at the current rate. And also next thing is I share already Fraser Centerpoint. I believe you will continue to do well and due to their resilient portfolio. Other than these two, other than the third pick, maybe I will say that it's actually Maple. There's other two I can't really decide, but it's actually CapitaLand, the CapitaLand Trust in the China Trust. So actually, they are actually focusing on the China side. So actually, you know that CapitaLand, they intend to grow from their current assets from 1.5 billion to around 5 billion over the next few years. So CapitaLand China Trust, right, is the one of the beneficiary, what they can help them to grow also. Next thing is also this actually giving quite attractive dividend. Other than this, also Mapletree North Asia Trust. Mapletree North Asia Trust is in Hong Kong. It's actually their main income is actually coming for festival work in Hong Kong. However, over the so-called over the past few quarters, they're actually going to diversify more and buy into other assets. So I'll prefer them. They're currently trading under below price to book ratio. I expect them with the diversification to other market like Korea, Japan, all this to help them to become more diversified income. It's better, also better for the REITs. Okay, I think maybe I will. Alex, are you there?
Hi, Mike. Yes.
Okay, maybe I can hand over to you to actually continue the second portion first. After that, we'll do Q&A again.
Okay, sounds good.
Okay, thanks.
Thanks. Hi, everyone. I'm Alex from Samsung Asset Management. So I hope you will be able to see my presentation. So today, the topic is about REITs, and I think Mike has already covered quite extensively about REITs, individual REITs already. But because we at Samsung are a ETF issuer, we are going to approach this topic from a different perspective, which is a REITs ETF. I think a lot of Singaporean investors are also very familiar with investing in REITs through a diversified ETF portfolio as well. So I'm gonna talk a little bit about how to use a REITs ETF as an income generating tool, especially in the current low yield environment. But before that, just bear with us a little, several minutes to share a little bit about who we are. So we are Samsung Asset Management, part of the Samsung Group, the Korean conglomerate. And we were founded back in 1998 as a fully owned subsidiary of Samsung Life Insurance. So currently we are the largest fund manager as well as ETF issuer in South Korea, which collectively manages $256 billion US. We are also a pioneer in ETF exchange traded fund. So in Korea, we have the largest ETF series branded under Codex, which represents 52% of the market share in the country. We were also the #1 for various different categories and have been the first over the course of the past 20 years. So for example, back in 2002, we were the first to launch ETF in South Korea by launching an exchange traded fund tracking the KOSPI 200, which is the benchmark for South Korea. And then in 2009, we were also the first to launch leverage and inverse products in the country. And in fact, those inverse and leverage products were also the first in Asia. So in terms of our global footprint, we currently have 5 offices globally. So Hong Kong is the regional hub outside Seoul for Asia. So Samsung Asset Management Hong Kong was founded in 2007. And in 2016, we started our ETF business by launching the first ever futures-based ETF in Hong Kong. And that was also based upon our long-time experience from South Korea about leverage and inverse products and futures product. And actually, right now, a lot of Samsung branded ETFs that Singaporean investors will be able to access are listed in Hong Kong. For those listed in Korea, currently is mainly available to local investors only. So the reason why we would like to talk about REITs today is because we see a significant product gap for Asian investors, especially in the current low yield environment. Actually, we have been in a low yield environment for many, many years. But last year, due to COVID-19, the expectation that the low yield environment is gonna last for longer is actually much greater than before. And the US Fed has announced that they would keep the interest rate close to 0, at least until 2023. Other central banks are likely to follow suit as well, given the current market condition. So this has rendered a number of investment products with historically low yield or interest rate, So for example, the interest rate of deposits as well as the yield for bonds, especially investment grade bonds globally, have reached all-time low. Although for US Treasury, it picked up a little bit recently, but it's still much lower than the historical average. And in the equity space, some of the stocks that historically pay very decent dividends, such as some banking stocks in Hong Kong, like HSBC and Standard Chartered, also scrapped their payout last year due to the business impacts brought by COVID-19. So we see that investors are keenly looking at alternatives that are still available in the market that would help them deliver relatively stable and high dividend yield in the current low yield environment. And as an ETF issuer, we search across the entire market and find that REITs are actually one of the very few asset classes that currently still will be able to deliver that. So in October last year, we launched the first ever REITs ETF in Hong Kong, which is the Samsung S&P High Dividend APAC X New Zealand REITs ETF. So in the low yield environment, we believe that REITs could be the answer. So what exactly is REIT? I think Mike has covered this very extensively. So just very brief. So REITs can be considered a collective investment scheme. It delivers a source of recurrent income to investors through focused investment in a portfolio of income generating properties, such as shopping malls, offices, hotels, and service apartments. So what it means is a professional REIT manager will raise capital in the open market from investors and then invest in a varieties of different different properties with the purpose of collecting rents, collecting income. And then they would distribute a large portion of the taxable income to the end investors in the form of dividends at regular intervals. So by that definition, REITs is an income generating vehicle because in many jurisdictions, including Singapore and Hong Kong, REITs are required to pay at least 90% of their taxable income to investors in order to enjoy preferential treatment in tax. So the table below tells you the current status of the REITs market in Asia. So globally, the largest REITs market is US with over 200 REITs listed. The second largest market is in Asia, which is Japan, with 62 REITs listed. Australia has 47, Singapore has 46, Hong Kong has 12, and then South Korea has 5. And these are the most mature and long-lasting REITs market in Asia with a long track record for listing REITs. And the top 3 markets also happen to be the markets comprising the ETF that we launched in October last year. So what are the investment merits of REITs? What are the strengths of REITs, especially comparing with physical properties? Both of them provide exposure to the property sector. So what are the key differences? The first difference is about the low capital requirement for REITs. You can invest in REITs with as low as a few $100s. So for example, the Capital Integrated Commercial Trust, which is one of the largest REITs in Singapore, has a minimum investment amount of slightly over 200 Singapore dollars now. And even for some REITs related funds, such as our REITs ETF, the minimum investment amount is currently about 4,300 Hong Kong dollars, which is about 740 Singapore dollars. So in contrast, physical properties would require a much higher initial investment amount. It would require at least hundreds of thousands, even if you get a loan from the bank. The second investment merit or advantage of REITs is diversification. So as retail investors such as you and me, we may be able to just hold one or a handful at most of properties. And chances are we can only get access to residential properties. Most of our portfolio would be in the residential segment. It's relatively difficult for us to get access to commercial and industrial properties because a lot of these properties are private projects that are only available to professional investors. But through a REITs, we are open to a much broader sectors of different REITs, from retail to office to some of the more niche sectors such as retirement center, a hospital, a data center, or logistics centers, etc. So it provides much greater diversification. Let me just share one example, Stockland. Stockland is a REIT listed on ASX in Australia. And it's currently the largest holding in our ETF. It has a large collection of residential communities, shopping malls, as well as retirement centers. And actually, it is the largest owner and manager of retirement facilities in the country. Now, this segment is quite unique because it's relatively non-cyclical compared with retail and hotel, because the demand is more long-term and stable. As Australia is already has a aging population, so the demand is only going to grow stronger and stronger. So this also ensures that they would have relatively stable demand and cash flow. So for projects and properties like this, it might be difficult for us as retail investors to get access directly. But through a REIT ETF, we will be able to get access to them much easier. The third advantage of REITs is liquidity. So it's much more liquid for us to trade REITs because it's listed on the exchange and we can just buy and sell like a stock. If we invest in physical property and we want to exit the market, we would first need to identify a buyer, either directly or through an agent. Then we would need to negotiate the price and other commercial terms. Then we also need to complete the documentation with relevant authority. So the process would usually takes at least a few months. So by comparison, REITs is much more liquid. The fourth advantage is the asset accessibility. So as mentioned, it might be easy for us to gain access to residential property easily, but it's much more difficult for us to gain access to some retail and also industrial commercial properties. However, through a REIT, we would be able to gain access to all these different types of properties easily, just like a stock. The fifth strength is about the efforts saved. So one of the most troublesome aspects of holding physical properties is to manage the tenants and also to deal with the maintenance of the property. However, if we invest in REITs, we can pass all those issues, all those complexity to the management, to the good hands of the REITs manager. So we only need to trade just like a stock. So it's much more easier for us. However, with all these strengths, the REITs does come with a trade-off, which is the ownership. So if you invest in physical property, you will be able to gain direct control, direct ownership of the property. However, with a REIT, we are just one of the many investors investing in this listed REIT. And what we get is the shares, the units of the REITs instead of the direct control of the underlying property. Now that we have looked at the investment merits of REITs, let's also take a look at the REITs market globally and particularly in Asia. So globally, REITs are a growing sector to be reckoned with. By the end of 2019, the total market cap of global REITs has reached $1.7 trillion US. And if we look at the pie chart on the left-hand side, US is currently the largest market, accounting for 60% of the total market cap, followed by Japan, which is the largest REIT market in Asia, with a market cap of 120 billion, followed by Australia and Singapore. And if we look at the bar chart on the right-hand side, it provides further details, further breakdown of each market. So you can see that for different markets, they tend to have different types of properties, different types of REITs listed. In the US, there is a large portion of retail property. However, in retail REITs, in Japan, there is a larger percentage of diversified portfolios, while in Singapore, there is more focus on logistics centers and industrial REITs. So arguably, APAC REITs provides more diversification compared with the REITs in other regions. And specifically for APAC REITs, it's also growing very significantly. So for example, for the 10 years between 2009 to 2019, Asia Pacific REITs market capitalization has more than quadrupled to $416 billion US. In 2019 alone, Asia Pacific REITs raised a record-breaking amount of capital at over $14 billion US. So it speaks to the strong growth, strong demands for REITs among the investment community, and also the growing appeal of REITs in the region. And just now we have mentioned the investment merits of REITs in comparison with physical properties. But actually, REITs has some other investment appeals by its own virtue. So for example, REITs is a natural hedge against inflation. Because the value of property is expected to increase when inflation rises. And also property rents and values tend to increase when prices do. And some REITs in certain jurisdictions also have rental escalation clauses that are pegged to CPI, Consumer Price Index. Now let's take US as an example. In the bar chart below, we can see that we compare the dividend growth per share of REITs listed in US with the Consumer Price Index in the country. So for the past 15 years from 2004 to 2018, we can see that for all the years but 1 year, the dividend growth of US listed REITs have caused a positive correlation with Consumer Price Index. And actually, for all but 1 year, the dividend growth rate of REIT is higher than CPI. So this speaks to the great inflation hedge value of REITs. And in terms of diversification, while Hong Kong REITs are more concentrated on retail and office, we see that REITs in Japan, Singapore, and Australia has a relatively diversified mix. So for example, we can see logistics, industrial, data centers, energy storage, and even hospital and retirement centers. So these REIT segments are currently still relatively niche. They still represent a relatively small portion of the overall market caps for the REIT sector, but they are actually fast-growing segments of the market. And these segments tend to be less cyclical, and they are less affected by COVID-19 pandemic. Actually, some of the sectors benefit from the pandemic. So for example, one of them is logistics centers, which benefit from greater demand for online shopping and e-commerce during the lockdown period. And also data center also benefits from the greater demand for data and relevant servers because increasingly we are working from home and use live streaming and online conferencing device to facilitate our communication. So with an APAC REITs portfolio, we will be able to diversify our REITs and get different income streams. And another investment area of REITs, particularly related to the present moment, is the valuation. We see that APAC REITs has very attractive valuation at the moment. So to prove that, we compare several benchmarks. For Asia Pacific REITs, we use the S&P High Yield Asia Pacific X New Zealand REITs Select Index, which is also the underlying index of the ETF we launched in October last year. And we compare with a global REITs benchmark, which is the Dow Jones Global Select REIT Total Return Net Index. And we also compare with US and a European benchmark as well, which are Dow Jones US Select REIT Total Return Index and S&P Europe REIT Local Currency Net Total Return Index. And you can see in terms of the valuation indicators, price to earning ratio and price to book ratio, APAC REITs, as represented by this index, has the lowest PE and PB ratio compared with the other regions. And if we look at the bar charts on the right-hand side, it provides further insights into different parameters. So if we look at the green dots, which represent the average dividend yield, we see that Asian countries have higher or at least similar dividend yield to their US and European counterparts. But in terms of PB ratio, Asian REITs are much lower than the US REITs and are close to their European counterparts. So we have looked at the characteristics and investment appeals of APAC REITs. So what is the outlook of the sector in 2021? We see that there are still a number of factors that are going to be supportive to this sector. The first one is the low yield environment. It's gonna last longer than we previously expected before COVID-19. And actually, late last year, US Fed has announced that they will keep the interest rate close to zero, at least until 2023. So such a low yield environment is expected to benefit various income strategies, including REITs as well, based on empirical data. And actually, a low yield environment also means that REITs would have much lower funding costs for them to acquire new properties. And these new properties, once the pandemic is become less serious, would also generate further cash flows, further incomes to the underlying properties, which is gonna be beneficial to the REIT sector in the long term. The second trend is improving fundamentals, because the fundamentals of APAC REITs are expected to improve, mainly driven by several factors. One is improving economic outlooks and accelerating economic activities. The second one is higher occupancy rate. The third is greater cash flows among Asian markets. So this would also be supportive to the sector. The third trend is upward inflation. So inflation is expected to pick up in 2021 as economy improves. And this would be beneficial to REITs as well, because REITs, as mentioned, is a natural hedge against inflation. So it is against this this favorable backdrop that we launched the Samsung S&P High Dividend APAC X New Zealand REITs ETF in October last year. It is the first REITs ETF in Hong Kong. It is also the first REITs ETF in Asia that focus primarily on the developed markets in Asia and focus only on the high dividend segment of the REITs markets. So in terms of the geo markets, we currently only cover Australia, Japan, and Singapore. According to the index methodology, Hong Kong and South Korea may also be included in the future. The reason why we only focus on developed markets is because these markets tend to have more established and mature REITs markets, and the underlying properties tend to have relatively good track record in terms of delivering good cash flows. So compare with developing market. So we focus on the developed market for this ETF. But in terms of the sectors, we have a diversified of different sectors. Of course, there is hotel, office, and also retail, which represents the risk market, a large portion of the risk market globally. But there is also some relatively niche but up and coming sectors, such as data center, logistics center, energy storage, or even hospital and retirement centers. So these sectors have a different business cycle. Their business model tend to be different. The cash flow would therefore be different as well. So it provides diversification in terms of the underlying cash flow to a portfolio. So with this ETF, we intend to achieve both precision and diversification. Precision in the sense that we will focus only on the REIT sector, and diversification because we intend to cover as many different aspects of the REIT sector as possible. And in terms of the payout, we intend to have at least two payouts each year during June and December. And if conditions are right and also subject to the manager's discretion, we may also increase the frequency of our payout as well. Now let's also look at the characteristics of the underlying index, which is the S&P High Yield Asia Pacific X New Zealand REITs Select Index. Because ETF is a passive index tracking vehicle, so the characteristics of the underlying index will tell you a lot about the feature of a product. So this index was developed by S&P Dow Jones Indices, which is also the index provider for the premium US benchmark S&P 500. This REITs index is comprised of 30 REITs in developed markets across Asia Pacific with highest 12 months trailing dividend yield, excluding companies domiciled in New Zealand. The reason why we single out New Zealand is because the regulation there tend to be a little bit different. So there is no REIT structure per se in New Zealand, but has something similar. So strictly speaking, New Zealand should be excluded. The index will be rebalanced semi-annually in January and July. So this ETF can be considered a combination of income and growth strategy. In terms of the for income, its indicated dividend yield is currently 4.73%. The 10-year average yield is about 5.15%. Now this has come down a little bit to this level. A couple of months ago, the dividend yield was still 5.7%. The reason why it has dropped a little bit is because the price has gone up quite a lot, mainly because of the APAC REIT sector has been on the receiving side of a sector rotation. So more capital has flown into this sector recently. And also the outlook has become more positive because the introduction of vaccine and the expected acceleration of economic activities later this year. Also, in terms of the accumulated return, the 10-year return is 105%, which translates to about 7.5% per annum. So this is comprised of 5% of dividend yield, as mentioned, and also 1 or 2% of capital gain, if we take compounding into consideration. So arguably, you can say that this strategy combines both income and growth. And if we look at the following tables, shows you the sector breakdown as well as the market breakdown. So in terms of the sectors, currently, it has the highest weighting in retail REITs, which is just reflecting the current situation of the REITs market globally. Retail REITs still represent the highest weighting globally in terms of market cap. but we also intend to increase the weighting of diversified REITs and industrial REITs based on our index methodology. And in fact, on January the 29th, we have completed the latest rebalancing. And now diversified REITs become the largest sector within this ETF. And currently, it has over 30% of weighting in diversified REITs. And in terms of the market's exposure, so currently Australia has the largest weighting as of December last year. Japan follow, and then is Singapore. And after the rebalancing, Japan becomes the largest market in terms of weighting, mainly because Japanese REITs has gone up quite a lot in terms of its price recently. So let's also look at its recent performance, especially by comparing with REITs market in other regions. So again, for APAC REITs, we would use the S&P High Yield Asia Pacific X New Zealand REITs Select Index as a proxy to represent the APAC REITs market, and we compare with the global benchmark as well as the US and European benchmark. And you can see that for multiple time horizons, regardless whether we are looking at short-term, mid-term, or long-term, the APAC REITs outperform by a clear margin. And if you remember, in March last year, there was a liquidity crunch that hits all the asset classes across the board, including equity and fixed income. And REITs as part of property is also inevitably affected because of the liquidity crunch. But since then, APAC REITs has rebounded quite significantly. It has rebounded over 88%, whereas the global REITs portfolio or US REITs only rebounded 51%, and European REITs only rebounded 24%. So this also demonstrates the strong resilience of APAC REITs during and after the market downturns. Let's also take a look at its the performance comparing with the equity asset class, because REITs is generally considered part of the equity asset class. So here we compare the same benchmark with a broad-based Asia Pacific REITs index, as well as various country index, where measuring the countries that comprise our ETF. So you can also, so for example, Nikkei 225 represents Japan, ASX 200 represents Singapore, Straits Times Index represents, ASX 200 represents Australia, and Straits Times Index represents Singapore. And you can see that for short term, such as 1 to 6 months, and long term, such as 5 to 10 years, the APAC REITs index also demonstrates strong outperformance as well. So this also shows the sector superiority of APAC REITs, comparing with the broad-based equity sector and compare with other subsectors within the equity asset class. So beyond performance, let's also take a look at the dividend yield as well, because our ETF plays such a great importance on dividend yield. So as mentioned, the underlying index currently has an indicated dividend yield of 4.373%. If we compare with the other asset classes, for example, deposits, the interest rate is currently almost negligible. For example, a 1 month Hong Kong dollar saving deposit in a Hong Kong local bank has a interest rate of just 1 basis point. The same case for US dollar deposit. And if we compare with equity, for a broad-based global benchmark such as MSCI ACWI index, the dividend yield is currently 1.76%. And if we compare with the benchmarks that comprise of our ETF, again, Nikkei 225, ASX 200, and Hang Seng Index, the dividend yield is between 1 to 2.7%. So only Australian benchmark has a relatively high dividend yield, but it's still 2% lower than high dividend APAC REITs portfolio. And if we compare with fixed income, currently the 10-year US Treasury has a yield of just 93 basis points, which is close to all-time low. And if we compare with an investment grade portfolio, a global investment grade portfolio, currently the yield is surprisingly even lower at 88 basis points. So only a portfolio of global high yield bonds would have similar yield to an high dividend APAC REITs portfolio. So for example, the Bloomberg Barclays Global High Yield Index currently has dividend yield of 4.42%. So just now we talked about the diversification value of REITs compared with other major asset classes. So how about for this particular APAC REITs portfolio? Does it also deliver the same diversification value, just like the REITs in general? So here we also compare the same index with the major benchmarks of different asset classes. So for example, for bond, we use the Bloomberg Barclays Global Aggregate Index, which is a broad-based index that covers multiple different types of bonds for different ratings, different maturities, and different markets. And currently the correlation is just 0.3. If we compare with commodity, we use the S&P GSCI Commodity Index. Again, it's a broad-based index that covers multiple different types of commodities, from precious metal to industrial metal to livestock to agriculture, etc. And the correlation is 0.2. And if we compare with equity, again, we compare with multiple regional and single market benchmark, and the correlation, although it's higher, it's still between 0.4 to 0.7. So only the correlation with strict times index is slightly higher. But this is understandable given REITs play such an important role in Singapore's equity markets. Okay, by now you probably have a question about the index design, because in the index design, we mentioned that we select constituents based on the trailing 12 months dividend yield, which is a backward-looking perspective. So can we ensure that the portfolio would have a reasonably high dividend yield in the future, just similar to the historical yield? So with that, we also look at two forward-looking indicators. One is projected 12 months dividend yield. The other is current occupancy rate. So for projected 12 months dividend yield, we use the Bloomberg consensus, which is an aggregate estimate of future dividend yield by sell-side analysts that cover the constituent stocks of our ETF. And you can see that for all the constituents, the dividend yield is between 3% to 7%. Some of them are as high as close to 8%. The simple average is 5.3%, which is still a very healthy average, healthy dividend yield compared with the historical average of 5.15%. And if we look at the current occupancy rate, here we use the occupancy rate extracted from the quarterly or semi-annual report to make sure that it's most relevant to the current situation. And if that is not available, then we use the data from the annual report. And you can see that the occupancy rate for all of the constituents, the occupancy rate is 90% or above. And for most of the constituents, the occupancy rate is 95% or above. So this is still a very healthy occupancy rate compared with other regions and compared with the historical average. Such relatively high occupancy rate is also going to ensure that the underlying portfolio would have relatively stable income stream in the future. So now that we have looked at the characteristics of the underlying index that we track and also the investment appeals of the REITs market in general, let's also look at how we can use a REITs ETF. What are some of the use cases that you as an investor can consider? So in general, we believe that REITs is quite unique in the sense that it lies in the intersection of an equity sector ETF and an income generating product. So it actually has a broad variety of different use cases, both for institutional and retail investors. Now, I would talk a little bit about how institutional investors can use it because some of these use cases are not limited to institutional investors only. They may also provide some value to you. You may also consider to use it. So we see that some insurance companies, wealth managers, or discretionary portfolio managers can use this REITs ETF for tactical sector play, especially by capturing the post-COVID-19 rebound. And we also see that some institutional investors use it to enhance their asset allocation as well. So for example, if you have a broad-based equity portfolio, or if you have a fixed income portfolio, but you want to tilt the weighting towards an income strategy to increase the yield of the overall portfolio, then you can add this REITs ETF as a satellite to increase the yield. So that's why it can also be used for yield enhancement. We also see that some investors may potentially use it for liquidity management as well, especially when they are switching strategy or when they are rebalancing their portfolio. So they can park their investment capital in this ETF in the interim while they are identifying a new opportunity to get in at the right time. So during the period, they can also receive the dividend from this ETF. For insurance companies, we potentially also see some of them could use this ETF, could utilize the dividend from this ETF to support their payout obligations as well. So for retail investors, we mainly see three use cases. One is for tactical sector allocation, again, by capturing the post-COVID-19 rebound. And also some investors may use it to broaden their market exposure as well. So previously for retail investors, especially in Hong Kong, if they want to access REITs, chances are they can only access individual REITs listed in Hong Kong because previously there was no ETF listed, REITs ETF listed in Hong Kong. And if they want to go beyond the local market and access the other markets, then they would need to handle the complexity such as different trading hours, different taxation policies, or different settlement cycles. Now with this ETF, they would be able to access multiple segments in multiple markets in just one trade. And last but not least, we also see that even larger portion of the retail investors mainly utilize this ETF to secure a relatively stable income streams, especially given that currently in this low yield environment, there are not many options for investors to have a relatively stable and high dividend income. So a REITs ETF can come in to play that role and provide relevant income, relatively stable income stream in the current environment. So with that, I would like to conclude my presentation. Thank you very much for your time. And if you have any question about REITs in general, about ETF, or particularly about this product, please feel free to reach out to us through these 3 different ways. And I would also stay behind a little bit to answer any potential questions you might have about this ETF. Thank you very much for your time.
Thanks, Alex. Okay, maybe look at some of the questions. Let me see. There's quite a number of questions. Okay. Regarding someone has mentioned regarding to sponsor and their credibility, what are the protective measure that we can take in the case of Eagle Hospitality? I think last year Eagle Hospitality had default and caused quite a lot of issue. So what we want to look out for, right? First of all, we usually look out for the sponsor. So if the sponsor is those not well known, or maybe they are more not transparent, right? In that case, we may want to actually avoid this kind of risk, because with a strong sponsor, like you can see well-known strong sponsor like CapitaLand, Fraser Property, Mapletree, right? They can actually help the REITs to grow. However, if the sponsor is actually not that transparent and well-known, right, they actually cause the REITs to actually slowly go down the hill over time. So you can see also in other example also. Then someone mentioned that from Facebook, Ascendant REIT is actually focused on industrial sector. So actually for Ascendant REIT, right, it's actually focused most, it's actually just not industry, it's actually a mixture of commercial and industrial. So industrial wise, it's actually not so affected by the work from home, but for the commercial side, they can be actually affected by the from the work from home, because they are commercial is mainly dealing with offices. So what actually Ascendants do is that actually they are also quite actively engaging their existing tenders on all this. So what you want to look out for is actually we talk about is actually the occupancy rates. We see that whether it's actually continue to deteriorate over time, or they are actually able to keep above the 90% or even best 100%. Alex also mentioned that this is also an indicator can help you to look forwards of the rental forward dividend yield or rental income. Okay. Alex, I think there's a question on the REITs ETF charge. Maybe do you have any detail on the REITs ETF charge that you mentioned just now?
Sure. Let me take a look at this question. So in terms of the charge, currently the management fee is 0.65%. So that's the management fee. And in terms of the total expense ratio, which includes the trustee fee and legal fee and other expenses that ensure the normal operation of the ETF, the total expense ratio would be kept at 1.5%. Because our ETF was just launched less than 1 year, so according to regulation in Hong Kong, we are required to cap all the expenses under 1.5%. But with the increase of our AUM, it's likely that the total expense ratio would drop with the increase of the AUM.
Okay, thank you. Let me see. Then someone actually asked, what about First REITs? So actually, First REIT is also the sponsor is actually Lippo Karachi, who share the same sponsor as Lippo Mall Trust. So you understand that actually, Lippo Karachi wise, they hasn't been doing well. So actually, Lippo Karachi is also one of the so-called main tenders for this First REIT. So actually, they have really affected First REITs. So the outlook for First REIT wise is actually really depending on the Lippo Karachi. So I would say that outlook wise currently is not so good at the moment. And also you're looking at the whole Indonesia. Also, one thing is that Indonesia, other than just the management, right, we also look at the FX. So you can see that actually rupiah has been deteriorating against Sing dollars. So that's why if risk manager are unable to actually do proper hedging, right, you can see that actually they cause the overall risk to income to also deteriorate over time. So actually, I think there's quite a number of questions on first REIT. So actually, for me, I will just avoid because there's quite a lot of uncertainty. And also now first REIT has two sponsors other than Lipo Karachi. You also know about OUE. So this one means that if you are holding first REIT, you can expect quite a lot rights issue when they inject assets over time. Okay, someone has actually asked another question. How long do I need to hold the risk so that I can entitled to the dividend? So next thing is that to entitle for dividend, you need to think of the CD date come dividend. If you actually hold the dividend on the to the XD, right, means that you're on the XD date, you can actually sell off the shares and you're still entitled for the dividend. However, for risk, usually you actually hold for long term, not really just hold to the dividend and after that you sell. Okay, someone has also asked actually is rights issue, is it a good or bad thing? So I would say that if they are doing rights for the risk, if they are doing rights issue and they are actually getting assets that are actually in terms of dividend ill accretive, right? Also the help the property to actually the whole overall portfolio to grow over time. Actually, rights issue are good. However, if you are doing rights issue to keep the risk sustainable in the first REIT case, right, this may not be actually a good thing. I think just now actually quite a number of questions have asked about what is the ETF that he shared just now. It's actually I think I shared inside the chat group. You can take a look at the link the Samsung S&P High Dividend Apex XE New Zealand REITs ETF. You can take a look at that. Okay, I think most of the questions are quite similar. Then the next question actually people has asked whether do you recommend US REITs. So actually we have mentioned that some of these US REITs inside our stock BNB. Just now we see the reports. Actually they are actually trading as quite a attractive discount. So actually you can consider looking at the latest research reports. Is from there they actually talk about some of these REITs, right? You can take a look. So I think there's actually a few. Give me a moment. So they mentioned actually you can look at the manual US Life REITs and also the Prime US REITs. These two can consider taking a look. Okay, I think the next question is with regular investment approach, it takes time to monitor and track, and some may prefer to invest and leave it there to earn passive income, hence buying at a low. Isn't that so? Okay, one thing is that you have to think note when you are doing investing, you need to set your investment goal and objective. So from there, after that, how are you going to achieve? Are you going to buy regularly, or do you have actually outfund a huge sum of capital to straight away invest? And also one thing is that when you're investing, right, for over a long period, it's good to always do a review because sometimes the fundamental for the company have already deteriorated. Like for example, first REIT is one of the best example. If you compare before a few years ago, actually first REIT is actually doing well. However, you can see it when actually the fundamentals start to deteriorate, right? The share price also continue to deteriorate over time and end up they actually have to do rights issue. So that's why it's investment wise, it's not good to just buy and leave it there. You need to still need to actually do monitoring. in case you are not really able to do monitoring, and sometimes actually ETF do help because, like for example, Samsung Asset Management, all these ETF, they have fund manager who actually help you to do monitoring of this, and they will do actually portfolio adjustment instead of you are doing portfolio adjustment on your own. Yeah, so I don't recommend just buy and hold and forget it. You need to actually continue to do review and see whether actually the fundamental of this stock have deteriorate, or if not, you can consider the ETF. I think just now we mentioned the stock code is the 3187. You can take a look. Yeah, I think just I answer the first regarding the first REITs, right? I will avoid because there's quite a lot of uncertainty in this first REITs.
Hi, Mike. I think I would just answer the question about the dividend payouts for this ETF.
Okay, sure.
So thank you. So in terms of the dividend payouts, we intend to at least pay 2 times each year in June and December. And if conditions are right, we also intend to increase the distribution frequency as well. So potentially we will also pay in March and September, but that's subject to regulation and also the discretion of our manager. So this is our payout policy. And also, actually for this ETF, there are 2 currency counters. So 3187 is the Hong Kong dollar counter. And if you want to trade this ETF in US dollar, we also have a US dollar counter as well. The stock code is 9187. Thank you.
Okay, someone has asked if you need to sell off REITs, will you sell off capital REITs or escort REITs trust? I'll say that first of all, maybe you need to compare which one is not able to help you to achieve your goals. Because if both REITs are actually still doing well, then you may not want to actually do anything adjustment to that, unless you are actually really require money. So in terms of these two, right, if you compare, they are both, one is in terms of commercial side, one is actually hospitality. Well, I expect hospitality may not be able to do, it's unlikely to do well in the short terms. If you really need money, then in that case, you may want to actually liquidate escort trust first. Okay, someone also has asked, is there any significant advantage between REITs that pay out quarterly, half yearly, or yearly basis? Okay, one thing is that actually you depend on your cash flow. Are you going to use the dividend to reinvest? If it's reinvest, sometimes quarterly may have advantage because straight away you can add on, like for example, I have 2005 to invest every month. And then let's say the dividend come in another every month I'm getting 300. So if it come out quarterly, I can actually reinvest into market easily. So in that case, quarterly may be better. Yeah, so actually other than that, actually there's not really any significant advantage between the risk payout quarterly, half yearly, or yearly basis. Okay, someone has asked any in sync. I believe you are asking whether Samsung Asset Management, they really offer the ETF in sync. I think for this ETF, it's only offered in USD and Hong Kong dollars, right?
That's right. Yes. So for Singaporean investors, I would suggest that actually it's also available to trade through a Phillip local account, but you will need to trade in either US dollar or Hong Kong dollar.
Okay, thank you.
Thanks.
answer last 1 to 2 questions before we end off this webinar. Give me a moment. Let me take a look. Someone has actually asked about SPH REITs. So actually, first of all, if you just ask me about SPH, right? First of all, who is the sponsor? SPH, Singapore Press Holding. It hasn't been doing that well. So from a sponsor point of view, right? Actually, don't really like this REITs already. And the performance of the REITs, you can see actually they hasn't been performing that well over time because you mentioned strong sponsor is important for the REITs to grow. However, for SPH, they hasn't been managed well, so indirectly actually affect the SPH REITs. Alex, maybe do you know about the withholding tax? Is there any withholding tax for Apex REITs ETF?
So no, there is no withholding tax for any Hong Kong listed ETF actually. So even for APEC REITs ETF, there is no withholding tax on any dividend.
Okay, thanks. I think maybe you just answer the last question. Okay, do I have to worry about the value of USD? So sometimes if you are investing in the overseas, regardless is it whether is it stock, whether is it REITs, all this will be actually subjected to US fluctuation. So for US wise, you can see actually they have been printing a lot of money. So with all this money, right, there'll be a lot excessive supply in the market. So this one can actually cause the USD to continue deteriorate. So sometimes it's good to have a portfolio of a diversified portfolio. You don't just focus on REITs that come from US, you have from Singapore, overseas. So you actually have a diversified portfolio. Like for example, the REITs ETF is also a diversified portfolio. So in that case, you are not particularly significantly affected when there's a so-called deterioration or devalue of a certain currency. So it's good to have a diversified portfolio to diversify out the risk.
Mike, can I just add one point from an ETF perspective?
Okay.
So yeah, for our ETF, the base currency is US dollar, yes. But the underlying markets are like Japan, Australia, and Singapore. And if US dollar depreciated, actually, it would be beneficial to our portfolio because the underlying stocks are traded in Aussie dollar, in Japanese yen, and in Singapore dollars, right? So what would happen is that it would be converted first into US dollar, and then if you are trading the US dollar counter, so then what you'll get is the return in US dollar plus the currency appreciation of the local currencies. And if you are trading in Hong Kong dollar, then this ETF would convert it from US dollar further into Hong Kong dollar. So actually, the US dollar depreciation wouldn't be too much of a issue because that would mean that the underlying markets of our ETF would actually have an appreciation. So just a point to add.
Okay, thank you. So I think we have actually come towards end our webinar. We are really glad to have you to share more about this ETF because some of the clients may, even after that, they may not be able to identify the fundamental of this so-called risk on their own, or they may not have time to actually manage. So sometimes through an ETF is actually a good way to actually diversify our portfolio. And in that case, you don't have to do active management. So
thank you very much for your time.
Yeah, thanks for everyone for joining, and have a good evening. Thank you.
Thank you. Bye.
Right.